All right. It is 4:15 p.m., Friday, February 6th. The bell has rung, the books are closed, and the dust is finally settling on a week that felt more like a fiscal year. Let's get straight to the final scoreboard. The Dow Jones Industrial Average, a headline number, the one that's going to be plastered on every screen this weekend, closed up 0.22%. That marks a historic close of 50,097. We have officially crossed 50K. The S&P 500, it edged up 0.12%. And the Nasdaq 100 actually slipped, down 0.08%.
On the surface, if you just glance at those percentages, it looks like a choppy, indecisive mess.
Yeah, flat.
Right? You've got the S&P and the Nasdaq basically flatlining. But if you think this was a quiet day, you were not looking closely enough. The real story isn't the percentage move. It is the sheer psychological weight of that Dow 50,000 print and the chaos underneath.
That is the barrier everyone has been staring at for months. 50,000. It sounds massive. But we have to ask the hard question right off the bat. Was this a legitimate breakout, or was this just window dressing for the weekend? Because crossing a line on a chart is one thing, staying there is another.
That is exactly the right skepticism to have. And to answer it, you can't look at price. You have to look at the volume. All morning, it felt like, everyone had left for the Hamptons early. Low energy, low volume, typical Friday doldrums. But then look at the final tally. We ended with high conviction. We are talking 115% of the average daily volume.
That is a significant jump from where we were at noon. What changed?
The narrative flipped. This tells me this wasn't some dead cat bounce. This was a structural stop-in. I mean, think about the psychology of the trading desk right now. On Thursday, the story was fear of obsolescence after that software wipeout. By Friday afternoon, that flipped completely to fear of missing the floor. The selling exhaustion is real. Traders didn't just nibble at the close. They backed up the truck. They were terrified of being underallocated going into the weekend.
Okay, so we have volume confirming the move on the Dow, but I want to look under the hood at the rotation because the Nasdaq was red while the Dow was hitting records. That is a massive divergence. Who was actually doing the heavy lifting today?
And this is where that head fake versus breakout debate gets nuanced. It wasn't a broad rally. It was a specific rotation into cyclicals and financials. You had JP Morgan and Caterpillar leading the charge. These are not the sexy AI names. These are the old school industrial giants rescuing the S&P from its 50-day moving average. It's the old economy bailing out the new economy.
And looking at the sector leaderboard, I see something that makes me nervous. Utilities took the top spot. That just screams defensive positioning, doesn't it?
It absolutely does. And it's the single biggest red flag on the board today. Think about it. When utilities are the sector leader on the same day the Dow hits an all-time high of 50K, that is a huge contradiction. Utilities are bond proxies. They're where you go for safety and yield.
Right.
If traders were truly bullish on the economy, they'd be buying consumer discretionary or industrials. Instead, they are parking cash in the safest, most stagnant sector possible. They're buying the breakout, but they're hedging it at the same time.
So they want the exposure, but they don't trust the engine. Speaking of trust issues, look at the laggard today. Technology. High-duration names were just taking profits.
Right. As 10-year yields hit resistance, the math gets harder for tech. But we have to talk about the context here. Earlier this week, we saw what the street is calling software-mageddon, a $1 trillion wipeout in market cap.
And just to clarify for everyone listening, $1 trillion just vanishes in a few days. How much of today's action is just a reflex reaction to that flush?
Oh, it's the primary driver. The institutions are essentially front-running next week's CPI data. We saw aggressive buy-the-close MOC imbalances. The desks are betting that the Jan-Feb correction found its floor. They looked at that trillion-dollar flush in software and said, okay, that was the capitulation event. They think the worst is over.
But is it? Because we have a tale of two trades today that really highlights how split this market is. On one side, you have the bearish outlier, Amazon.
Yeah, Amazon is squarely in the penalty box, down 6.5% to 9% at the close. Even with the Nasdaq holding up, Amazon is being punished as a CapEx-heavy stock. The market looks at that $200 billion spending plan for data centers and says, show me the returns first.
It feels like the market has shifted from rewarding promise to demanding proof.
That is the shift of 2026. For 3 years, you could just say AI and your stock went up. Now, investors are doing the math. Amazon is spending a fortune to build the infrastructure. That hurts margins. The market hates margin compression.
And on the complete opposite side of the spectrum, you have the lullish outlier, NVIDIA.
Up 7%.
Yeah.
The market is explicitly rewarding pure AI winners. It is a complete decoupling. If you are spending money to build the infrastructure like Amazon, you get sold. If you are selling the chips that everyone is compelled to buy, like NVIDIA, you get bought. One company's expense is another company's revenue. It's that simple.
There was one other massive move that we need to flag. The crypto markets. Bitcoin had a wild 24 hours. Why does this matter for the equity trader?
Yeah, because Bitcoin is the purest gauge of risk appetite in the system. It never closes, and it has no earnings reports to hide behind. We saw an overnight low sub $64,000. That was a liquidity grab, panic selling. But by the time the equity markets closed, Bitcoin ripped back above 70,000. That is a 12% swing.
That is a classic institutional V-bottom.
Exactly. And it tells you there is still massive liquidity sloshing around looking for a home. When Bitcoin refuses to die and rips 12% in a day, it signals that the animal spirits are still alive. People are scared, but they're also greedy. That same buy-the-dip psychology is what propped up the S&P today.
Okay, let's unpack the internals. Because while the Dow 50K headline is great for the evening news, the breadth data paints a much uglier picture. We're calling this the thin ice rally.
Thin ice might actually be generous. The advanced decline ratio was a pathetic 1.1 to 1.
Meaning for every stock that went up, one went down, even on a record-breaking day.
Precisely. In a healthy bull market, a breakout to new highs usually sees an AD ratio of like 3 to 1 or better. This is not a rising tide lifting all boats. This is a couple of mega-cap tugboats pulling a fleet of sinking ships. The equal-weighted indices lagged the market cap-weighted S&P by 80 basis points today. That's a massive spread for a single session.
And for those who don't watch the equal weight index, that essentially strips out the size advantage of the big tech companies.
Right. It treats NVIDIA the same as a regional bank, and when the equal weight lags by that much, it tells you the average stock is not participating.
And when you dig into who those tugboats are...
It's the AI infrastructure trio. They accounted for 70% of the gains today. If NVIDIA sneezes, there's absolutely no safety net below this market.
That brings us to the VIX. We saw a volatility crush today. The VIX plummeted 6%, breaking right through that 13.50 support level. Usually a dropping VIX is good for stocks, but you seem concerned.
I am concerned because of how it dropped. This is an IV crush. Implied volatility got incinerated. Traders were hedging for a quiet weekend, so options premiums just collapsed. But here is the risk. We are back in the danger zone. Complacency is high. Market makers are selling delta, forcing a mechanical bid, but the market has priced out the tail risk from yesterday's jobs data way too aggressively.
Okay, can you explain that selling delta mechanic? How does the VIX dropping force stocks up?
Sure. So when implied volatility drops, dealers, the market makers, find themselves long volatility. To hedge that exposure, they have to buy the underlying stock. It creates a mechanical feedback loop where a falling VIX forces dealers to buy equities, pushing prices higher. But that buying isn't based on fundamentals, it's based on math. And math works in both directions.
It feels like everyone is looking at the price action and ignoring the engine warning light. The McClellan oscillator is still negative, even though the S&P printed a fresh 52-week high.
That is a classic divergence. Price makes a higher high. Internal momentum makes a lower high. That is a textbook bull trap setup. It tells you that institutional smart money is quietly rotating into defensive staples like we saw with utilities, while retail is chasing the breakout in the tech names.
So we have a hollow breakout on the charts, bad breadth, and complacent volatility. Let's look ahead to Monday. We are walking into a macro catalyst right out of the gate.
Yes, Monday pre-market, we get the January inflation print. That is the volatility event that the market completely ignored today.
Let's look at the gamma picture. We talk about gamma levels a lot, but simply put, these are the battle lines where dealers have to act. Where are the lines in the sand for Monday morning?
The ceiling of pain is at 6,150. Dealers are long gamma up there. That means if we rally into that number, they will sell to keep the market pinned. They don't want it breaking out above that because it exposes their books.
And the downside?
The key support is 6,080. That is the line in the sand. If we break below 6,080, the positive gamma environment flips to negative gamma.
And why is that flip so dangerous?
In positive gamma, dealers act as shock absorbers. They buy dips and sell rips. But in negative gamma, they do the opposite. They sell into a falling market to protect themselves. Selling begets selling. If 6,080 goes, we flush towards 6,000 fast because the dealers amplify the move rather than dampening it.
Based on the closing data today, what is the probability play for Monday?
Statistically, looking at our database of Friday closes like this, we have 54% chance of a trend day continuation. But, and this is a big, but historically, a Friday trend day without a macro catalyst often leads to a gap and crap on Monday.
Gap and crap? Colorful but accurate. Walk us through that scenario.
So the market gaps up on the open because retail investors spend the weekend reading about Dow 50K. They put in buy orders for Monday morning. The market opens high, but then the mechanical buying from the dealers that we saw Friday afternoon, it's gone. The weekend carry trade unwinds.
So the artificial support just vanishes as retail is buying in.
Exactly. Expect an early attempt to push higher, followed by a mid-morning reversal, usually around 10:30 a.m. as profit-taking hits.
That brings us to the strategy. We are looking at a high conviction setup for Monday, specifically the Monday mean reversion. You are actually looking at the short side here.
I am. The trade is to short the Friday afternoon ramp. I'm looking at SPX call spreads, selling the 6,150 and buying the 6,170.
Walk us through the rationale. Why fade this strength when the Dow just hit a record?
Because the Friday buzz was dealer hedging, not accumulation. It was mechanical. The volume was high, yes, but it was driven by options expirations and hedging flows. If we don't get a massive gap up on Monday, driven by a cool CPI print, that trade unwinds fast. I'm expecting a 40-point flush down to the 20-day moving average.
Okay, so we are cautious on the broad market, but you do have some specific stock plays for day two action. Let's start with the AI king, NVIDIA.
NVIDIA had that high volume breakout above 165. For Monday, I'm looking for the red to green move. I want to buy the dip. If it pulls back toward 163.50, that is the entry.
Why buy NVIDIA if you're shorting the S&P?
Relative strength. Even if the market pulls back, NVIDIA is the leader. Institutional flow is chasing the AI sovereign narrative. They aren't done buying it yet. We are targeting 172 on that trade.
You also have your eye on Palantir, PLTR.
Palantir is a different beast. It's a momentum play right now. It closed to session highs after a midday squeeze. I'm looking for an entry on a break of Friday's high, which is $72.40.
And where does that rocket ship go?
Target is $78. There is huge retail interest here, combined with a squeeze in short-dated $75 calls. This is a Gamma-fueled rocket. If it breaks that high, the market makers who sold those calls have to buy the stock to cover, and that just sends it vertical.
So to wrap this up, Dow 50K is here, but the foundation looks shapy.
The market is long and wrong at the 6,150 level. My final warning is this: do not chase the Friday close. The data says this move is hollow. Wait for the Monday morning shakeout.
Tighten those stops and keep your eyes glued to that 6,080 level. It's going to be a volatile open with the CPI print. We will be watching. See you at the bell.